Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies here, to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
So, Steve, it looks like the hopes for big rate cuts from the Bank of Canada are not what they used to be. The central bank's recent survey shows that not many market watchers are expecting more cuts. What's your take on this?
Well, Sandy, it seems like the Bank of Canada is aiming to keep things steady at the moment. The survey indicates that about 1 in 3 respondents think Canada might already be in a recession or headed towards one. But most expect the policy rate to stay at 2.25% for now, and possibly go up to 2.5% by the third quarter of 2027. This means the rate-cutting cycle we saw in 2024 might be over.
That's right. And for the mortgage market, this could mean a shift in how people approach fixed versus variable rates. With ongoing economic uncertainty, many Canadians are leaning towards fixed-rate mortgages for stability.
Exactly, Sandy. Victor Tran, a mortgage agent with Tango Financial, mentioned that with all the media buzz about the Bank of Canada possibly holding rates steady or even increasing them, Canadians are understandably cautious. They're opting for fixed rates to avoid the risk of fluctuating payments.
And there's not much difference right now between 1 to 5 year fixed rates and 5-year variable rates. Both are in the range of the high 3s to low 4s. But with fixed rates providing that peace of mind, it's not surprising they're gaining popularity.
Yes, the fixed rate market is definitely seeing a boost. Even though some banking giants have differing views on where the central bank's rates will end up, the general consensus is that we won't see significant cuts. Tiff Macklem, the bank's governor, even signaled that rates are unlikely to drop much further.
It seems like fixed rates are the preferred choice, especially with economic volatility and recession fears. As Victor Tran pointed out, having a locked-in rate for 3 or 5 years means that mortgage payments stay the same, which is a relief for many Canadians who have other fluctuating expenses to worry about.
Absolutely, Sandy. Fixed expenses like property taxes, utilities, and home insurance can increase, so knowing that mortgage payments are fixed for a certain period is reassuring for many homeowners. It's a significant part of their monthly budget that they don't have to worry about changing.
The Bank of Canada recently cut interest rates by 25 basis points on October 29th, aiming to steady the mortgage market amid ongoing economic uncertainty. The minutes from their last meeting highlight that persistent economic weakness and fallout from United States trade protectionism are significant factors influencing this decision.
That's right, Sandy. The effects of United States protectionism have definitely made a mark on the Canadian economy, particularly in business investment and hiring. The bank's governing council noted that hiring was weak and business investment was sluggish, which isn't great news for economic growth.
It's interesting to see that despite these challenges, consumer spending and housing activity have shown some resilience. Housing starts and resales have been up since spring, although there are still regional disparities.
Yes, but it's important to consider the caution stemming from job insecurity. With the unemployment rate rising to 7.1% in September, up from 6.6% earlier in the year, people are understandably cautious with their spending, particularly those worried about job stability.
Inflation has been another concern. It ticked up to 2.4% in September, mainly due to gasoline prices, but underlying inflation remains around 2.5%. The bank has signaled that monetary policy might be nearing its limits in terms of supporting the economy.
Exactly. The Bank of Canada's stance is that the current policy rate is about right to keep inflation close to 2%, while helping the economy navigate through these structural adjustments. They're keeping an eye on data, particularly on inflation and labor market conditions, to decide on any further moves.
For the mortgage industry, this environment means adapting to what some are calling a new normal. Lower rates offer some relief, but there's still a lot of uncertainty. The GDP is expected to be about 1.5% below earlier forecasts by the end of 2026, which presents challenges that monetary policy alone can't solve.
That's a key point, Sandy. The structural adjustments, like shifts in supply chains and new trade patterns, will take time to play out. Mortgage professionals need to be ready for these long-term changes and the implications they bring for the housing market.
The Canadian dollar has strengthened to its highest level against the US dollar this month, driven by a couple of key factors. Firstly, investors are optimistic about the expected reopening of the United States government. Secondly, the minutes from the Bank of Canada's recent meeting have reinforced the perception that the central bank's easing campaign is on pause. Steve, how do you see these developments impacting the Canadian dollar's performance?
Sandy, the Canadian dollar's rise is a reflection of a more stable economic outlook, at least in the short term. The loonie was trading slightly higher at one point, 40 per US dollar, which is approximately 71.43 US cents. This comes after it reached its strongest intraday level since October 31st. Investors are reacting positively to these developments, and the stability of the Canadian dollar is a sign of confidence in the market.
It's interesting to note how the U.S. government situation is influencing our currency. Mark Chandler, chief market strategist at Bannockburn Global Forex LLC, mentioned that the U.S. dollar and stock market performed well during the government shutdown, and with the House of Representatives aiming to end the shutdown, there's a potential for shifts in market dynamics.
That's right, Sandy. The shutdown's end could lead to a stronger US dollar and potentially impact the Canadian dollar in the short term. However, the Bank of Canada is focusing on broader economic indicators. They decided to look past the choppy annual inflation data and focus on underlying indicators, which suggests that their easing measures might be on hold unless another economic shock occurs.
And speaking of economic indicators, the Bank of Canada recently lowered its benchmark rate to a three-year low of 2.25%. They believe this rate is suitable for keeping inflation close to the target. Chandler pointed out that barring any unforeseen shocks, the Bank of Canada is likely finished with easing for now. This decision aligns with their goal of maintaining economic stability.
Exactly, Sandy. It's important to consider the external factors as well. The price of oil, a major Canadian export, settled 4.2% lower at $58.49 a barrel due to an OPEC report indicating that global oil supply will match demand by 2026. This shift from a previously projected supply deficit could have implications for the Canadian economy and its currency.
Absolutely, Steve. Canadian bond yields also fell, tracking moves in U.S. Treasuries, with the 10-year yield down 3.7 basis points at 3.137%. This reflects broader market trends and could influence investor behavior. It's a complex interplay of factors that the Bank of Canada will need to navigate carefully.
Indeed, Sandy. The Bank of Canada's cautious approach, focusing on underlying economic indicators and external market conditions, is crucial for navigating these uncertain times. For the mortgage and real estate industry, understanding these dynamics can help professionals make informed decisions in a constantly evolving economic landscape.
Steve, let's dive into the recent federal budget and its implications for the housing market. Advocates are expressing concern that the budget's promises might fall short in tackling affordability and supply issues. The government plans to spend $25 billion on housing over the next 5 years, but critics say it's not enough to meet the demand for new housing units.
That's right, Sandy. The Canada Mortgage and Housing Corporation estimates that to restore affordability to 2019 levels, we need between 430,000 and 480,000 new housing units per year over the next decade. Currently, we're building at about half that pace, so there's quite a gap to fill.
Kevin Lee from the Canadian Home Builders Association mentioned that the target is aspirational and that significant changes in federal policy are needed to achieve it. He questioned how the government plans to truly support home ownership across the board.
Lee's concerns highlight a broader issue, Sandy. While the budget aims to supercharge the housing industry with an initial $13 billion for the Build Canada Homes Agency, the focus is primarily on non-market housing. This includes social housing, which makes up less than 1% of total housing stock built annually.
Exactly, Steve. It seems like there's a lot riding on this one initiative. Clay Jarvis from NerdWallet Canada pointed out that the budget lacks details on how Ottawa plans to incentivize private investment to boost housing supply. He's concerned that without buy-in from the private sector and municipalities, the government's promises might not be fulfilled.
Jarvis makes a valid point. Relying heavily on Build Canada Homes could be a risky strategy if it's the primary driver for new construction. We need a more comprehensive approach that includes collaboration between federal, provincial, and municipal governments to remove barriers to home ownership.
Toronto real estate broker Kaylee Heaps echoed this sentiment, emphasizing the need for changes to land transfer and home vacancy taxes to spur more real estate activity. She also noted that high development charges are holding back new housing starts.
And there's the issue of the GST relief for first-time homebuyers, Sandy. The budget proposes removing the GST on new builds up to $1 million, with reduced GST on homes up to $1.5 million. While it's a step in the right direction, Kevin Lee argues that this relief should extend to all buyers, not just first-timers.
It's a complex situation, Steve. Clay Jarvis also mentioned that the struggling condo markets in cities like Toronto and Vancouver could benefit from such relief. But he warns that the current measure might end up being a gift to developers without adequately supporting resale buyers.
It's clear that while the budget has some positive aspects, there's still a lot of work to be done to address the housing supply and affordability issues effectively. A balanced approach that includes incentives for both new builds and resales, as well as more collaboration across government levels, will be essential moving forward.
The Toronto housing market has been struggling to find its footing this fall, Steve. According to the Toronto Regional Real Estate Board, home sales have dropped 9.5% year over year, and prices are still on the decline, despite an increase in new listings. Buyers seem to have more choices but not much motivation to make a move.
That's right, Sandy. The sales to new listings ratio is sitting at about 38%, which is well below the 50% mark that indicates a balanced market. With active listings up by 17.2% and average selling prices down by 7.2% from last year, it seems buyers are hesitant. Even though mortgage rates have softened a bit, the market isn't showing signs of a rebound.
Taz Zaide, a mortgage agent with Six Mortgage Group, mentioned that appraisals for properties closing now are coming in lower than when they were purchased in the summer. It seems like sellers are becoming more desperate, and buyers are holding back, potentially waiting for prices to drop further.
That's a key observation, Sandy. The market is quite flat right now, and many believe it could remain this way for the next 2 to 3 years. Despite improved affordability, buyers are still on the sidelines, possibly due to economic uncertainties and the availability of inventory.
According to RBC Economics, the broader market malaise in Toronto mirrors a national trend. Home resales in the area are about 25% below pre-pandemic levels, and the composite MLS home price index has declined by about 5% from a year ago. They cite factors like economic uncertainty and grimmer job prospects as influencing buyer behavior.
And it's not just Toronto. Other cities like Edmonton, Regina, and Winnipeg are seeing declines as well. RBC's analysis points to tariff-related economic uncertainty and lower immigration as key factors. But in contrast, cities like Montreal and Calgary have seen modest upticks in resales.
Taz Zaide advises clients to focus on their personal needs rather than trying to time the market, which is sound advice given the current climate. It seems like the best approach is to make decisions based on individual circumstances rather than waiting for the market to change dramatically.
Absolutely, Sandy. With the market being so unpredictable, it's crucial for buyers and sellers to assess their own situations and make informed decisions. This flat market might not be ideal for everyone, but understanding the dynamics at play can help manage expectations and strategies moving forward.
An interesting real estate transaction recently took place in Oshawa, Ontario, where a lakefront property sold for less than its 2016 purchase price. Despite having 100 feet of lake frontage, the property faced challenges in the market.
That's right, Sandy. The home at 477 Stone Street was initially listed for $1,450,000 in May of this year, but after several price reductions, it ultimately sold for $1,165,000 in September. This is below the $1,230,000 it was sold for back in October 2016.
It's fascinating to see how the market dynamics have changed over the years. The property, which is over 100 years old, had undergone significant modernization and expansion, yet it still struggled to find a buyer at a higher price point.
A big part of the challenge was the unique right-of-way arrangement for the driveway, which buyers found off-putting. The property was severed from an adjoining lot, leaving it with 0.44-acres of land, but accessing the double garage and 12 parking spots required using a shared driveway.
That kind of arrangement can definitely deter potential buyers. However, the home itself is quite spacious, boasting over 3,700 square feet above grade, with 4 bedrooms and 4 bathrooms. It seems like the location and the shared driveway were bigger hurdles than the home's features.
Despite the challenges, the property's lakefront location was a significant selling point. According to Barry Zhuang, the listing agent, the views from the kitchen and bedrooms were better than many other homes on the street.
It's a reminder of how important location is in real estate, but also how market conditions and unique property features can influence a sale. The fact that other homes on the street also reduced their prices by 20 to 30% shows broader market trends at play.
Indeed, Sandy. It highlights the current market dynamics, where even desirable features like lake frontage might not be enough to secure a quick sale. The market is challenging right now, and buyers are cautious, looking for the best value.
It's certainly a buyer's market in some areas, and properties with unique challenges need to be priced competitively to attract offers. It'll be interesting to see how sellers and agents adjust their strategies moving forward.
Absolutely, Sandy. The real estate landscape is constantly evolving, and understanding these dynamics is key for anyone involved in the market. Whether you're buying or selling, being informed and adaptable is crucial.
Let's talk about an exciting development in Ontario's rental housing market. Steve, Luna, and Fengat have teamed up to break ground on a new transit-oriented rental community in Brampton. This is a significant step towards addressing the growing demand for rental housing in the region.
Absolutely, Sandy. The collaboration between Luna and Fengate is noteworthy because it focuses on creating sustainable transit-oriented communities. This approach not only addresses the housing shortage, but also promotes more environmentally friendly urban development.
The new community is located near major transit hubs, which is a strategic move to encourage the use of public transportation and reduce reliance on cars. This is particularly important in a growing city like Brampton, where traffic congestion is a concern.
Exactly, Sandy. By integrating housing with transit options, this project aligns with broader urban planning goals. It supports the idea of complete communities, where residents have easy access to amenities and services, reducing the need for long commutes.
LUNA, which stands for the Laborers International Union of North America, is bringing its expertise in construction and development to the table. Partnering with Fengate, a leading investment firm, ensures that the project is not only well-funded, but also well-managed.
And the financial backing from Fengate is crucial. It allows for the development of high-quality rental units that meet modern standards for energy efficiency and sustainability. This is increasingly important as more people are looking for housing options that are both affordable and environmentally conscious.
The project is expected to deliver a range of rental options to cater to different demographics, including young professionals, families, and seniors. This diversity in housing is essential for fostering a vibrant and inclusive community.
It certainly is, Sandy. Providing a mix of housing options ensures that the community can accommodate residents at different life stages and income levels, which is vital for long-term community sustainability.
As the project progresses, it will be interesting to see how it influences the broader rental market in Ontario. With such a focus on transit-oriented development, it could set a precedent for future projects in the province.
Absolutely, Sandy. If successful, this project could serve as a model for other regions facing similar challenges with housing supply and urban sprawl. It's an exciting time for the real estate sector in Ontario, and this initiative is a positive step forward.
Let's wrap up today's episode with a look at the client-centric approach of HomeEquity Bank, which has been making waves in the mortgage industry. Steve, HomeEquity Bank focuses on Canadians 55 and older, offering solutions like the CHIP Reverse Mortgage TM. Their commitment to putting clients first is truly impressive.
Absolutely, Sandy. Home Equity Bank's dedication to understanding and empowering their clients is a significant part of their strategy. By focusing on the 55-plus demographic, they're addressing a unique market segment that often requires specialized financial solutions. This approach not only supports their clients' financial independence, but also promotes a sense of security and control in retirement.
Their 55 and Better TM campaign is a great example of how they're bringing real client stories to the forefront. These narratives highlight how their reverse mortgage solutions have helped clients regain financial freedom and peace of mind. It's not just about selling a product, it's about showing real-life impact and building trust.
That's right, Sandy. By sharing these client stories, Home Equity Bank helps demystify reverse mortgages. This is particularly important for mortgage brokers who can use these narratives as a tool to address common client concerns and highlight the benefits of such solutions. It's a strategic move that can enhance client relationships and drive business growth.
Another key aspect of their commitment is their investment in research. By focusing on the needs and goals of Canadians 55 and older, Home Equity Bank provides valuable insights that can influence national conversations around aging and home ownership. This research helps brokers engage in more meaningful discussions with clients about long-term planning.
And let's not forget their efforts in protecting clients against fraud, Sandy. Home Equity Bank has taken proactive steps to educate clients about common fraud schemes, providing resources not only for clients, but also for mortgage brokers. This helps brokers recognize suspicious activity early and guide clients safely through the lending process.
It's clear that Home Equity Bank is more than just a financial institution. They're building a support ecosystem for Canadians 55 and older. By partnering with mortgage brokers who share their client-centric values, they're helping retired Canadians take control of their financial futures and live the retirement they deserve.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.